think I'm a little bit conflicted in the sense that on one hand, I do think that we've highlighted some of the issue in terms of risk concentration in a typical 60-40 portfolio. We have 60% in equity, 40% in fixed income. If you viewed it from a pure asset perspective, 90% of the risk comes from equity. So I mean, I always joke with our pension client that when you come into the morning, the only thing that you need to look at is WEI on Bloomberg. That's the only thing that matters for your portfolio. And the problem is actually even worse when you actually consider your liability. When you think about the liability, a typical pension plan would have a liability duration of, let's say, call it 10 to 15 years. You truly have this gigantic bet on overweighting equity or long equity and short fixed income. So that's essentially the bet that most of the pension plans are actually engaged in. So on one hand, I think when I say I'm conflicted, I certainly agree with you that in the sense of diversification, we need to diversify that bet. I mean, if there are trillions of dollars betting on one bet, you know that there's going to be a problem. On the other hand, just in terms of thinking about the leveraging the treasury portfolio can potentially diversify away from the equity risk. Given the U.S. treasury rate is at 3.5%, U.S. debt to GDP ratio is about 300%, all-time high, right? And we've already seen the peaks in Europe playing out in terms of the sovereign risk that's embedded in there. While I think on a strategic basis, it may make a lot of sense to diversify the risk away from equity and into fixed income, into other sources of returns or risk. Just given the leverage onto the treasury, I mean, are you worried about sort of where the rate is? And tactically, should people wait or should people just jump in with sort of a risk diversification argument?
Well, it is true that yields are quite low right now, even though on a real basis they're actually quite good. And if we look back over the last 10 years, just to give an example, in 2008, just before the collapse occurred, bond yields are just about where they are now, and they actually did a very good job of diversifying in 2008. But it is true that there are issues going forward when it comes to the credit worthiness of sovereign bonds. Now, in the developed markets, though, it appears that's probably not as big an issue as we worry about, even though there is certainly a debt issue out there. Most of the developed markets have been carrying large deficits for some time. And it appears that that's not probably as big an issue. But I think the real danger in leveraging treasuries and leveraging sovereign bonds is really an inflation risk that you encounter with that. Now, while inflation doesn't appear to be an issue probably for the next year or two anyway, certainly there is an issue with that. And there is always the potential for hyperinflation. And because of that, it is important if you're going to use this, or LDI for that matter, which of course is also tied to this, that there be an inflation hedging component to the portfolio. And another thing which I believe, going back to the policy level, which probably has I don't believe been addressed, even though it's possible it has been, is that during hyperinflation you have to worry about bond volatility. One of the problems with most policy mix portfolios is they assume bonds have a 4% volatility or 5% volatility. During the 79 to 81 period, when we had hyperinflation in the U.S. and also in a lot of other parts of the world, bond volatility tripled during that period. So the 10-year Treasury basically had 14% volatility. And if you have that sort of level of volatility, then all of the policy mix will be thrown off. Certainly from the risk parity standpoint, if you want bonds to have the same volatility as treasuries, you don't need to leverage them anymore in that environment. And so you need to pay attention to that. And these are the kinds of dangers which are there. And to go with what Jim was saying, if a plan were to actually go ahead and institute more of a risk parity aspect to it, and even an LDI aspect to it, they would have to have contingencies in place for things like this happening. And that could be very difficult, as I've seen as well.
Eric, do you, in terms of the funds you guys are looking at and things, what care to comment on?
Well, I was going to make one comment, kind of based on what Jeff and Ed were saying, which are, and this goes to my comment earlier about drivers of return in terms of diversification, and that is that, I think in our thinking, correlation is a very backward-looking concept, and one thing we've tried to do is to be very careful, knowing that the next crisis never looks like the prior crisis, that we don't import unwanted risk into our portfolios based on a historical low or negative correlation in a prior crisis. And I think that, I think the Treasury example is a good one because it did work really well in the 2008 credit crisis, but you could make an observation that, you know, maybe in the next crisis, focus shifts from corporate to sovereign balance sheets, and the nature of the market concern may be completely different, which causes them to behave differently.
Mm-hmm. So I'm curious, Jeff, to go back to some of your opening comments there. I mean, do you find then that broadly you guys are approaching the risk management side of your portfolio construction process differently? And if so, what is that? What are some of those things that you guys are introducing now that you perhaps hadn't in the past?
Sure. So I think people probably know that BlackRock manages about $3.4 trillion on behalf of our clients. So we're the largest asset manager in the world. Probably not too many people actually know that our BlackRock solution, which is our risk management platform that we've actually been working with clients, currently advise about $9 trillion assets globally. And that number has also jumped quite a bit over the last 2 years, given people's need for risk management, for looking at risk in a systematic fashion. And so I think, on one hand, I think you certainly see there's a sort of a return issue. On the other hand, increasingly we're seeing more and more clients. I mean, I think the current debate is also quite a bit about how do you think about risk? How do you think about risk in a systematic and also somewhat holistic fashion? I can give you a value at risk number, which, to Eric's point, a lot of times that's based on back historical standard deviation that, we actually, if you do a value at risk metrics on September 12th, 2008, you won't get the Lehman Brothers bankruptcy next day, right? So I think it's actually very important to think about risk in a holistic fashion and really broaden the definition of risk. And I think to Ed's point, I think he was actually talking about this earlier a little bit, is also, I think increasingly we're finding clients more and more thinking about risk in a dynamic fashion. And also, Eric talked about be forward-looking, because the next crisis is going to be very different from what you have experienced. If you just purely based on a quantitative tool to say that, okay, this is my historical correlation, this is where my historical volatility is, and put that in, you have a gigantic correlation matrix, it looks very fancy, you pop up with one number, you say, okay, I'm okay with that. I think it's actually very important to think about that, first of all, this is backward looking. Second is also, risk is very different from uncertainty. And Nassim Taleb has been very big on talking about this. I think for people who want to read about food by randomness and black swan, I think it's actually very important for us to think about what is uncertainty, what is risk. And sort of a good analogy is actually, I lived in New York for quite a few years. If you want to sort of calculate when the next subway ride is going to come, if you take the number E train, which I took for quite a few number of years, there's a model you can come up with. there is some sort of a statistical model you can come up with to calculate when the subway is going to come next. But there's also what we call as a coconut issue. You go to the beach, you lie underneath the coconut tree, and think about when the coconut is going to drop onto your head. That's an uncertainty issue. And that I can guarantee you, I have a PhD, and I can guarantee you it doesn't matter how many PhDs you got, it won't solve that uncertainty issue. And it's to recognize the fact that in risk management, there's a risk that you want to consider. I think you need to have a platform, think about risk in a quantitative fashion. That's a basic starting point. But at the same time, the uncertainty is much more difficult, and it actually needs to be much more forward-looking.
One comment on that, having worked with quantitative models for my first 10 years at Callan, I've had an appreciation for that old adage about a quant being much like a person who sticks his head in the oven and his feet in the freezer and says, I feel fine. And I think right now we're at an inflection point in the economy where, I feel queasy because I'm not sure whether I'm going into my foot, where I'm going into the oven or I'm going into the freezer. And that's why I think as you look at these models, people are saying, gee, I see that average correlation, but the scenarios now are much more clear and distinct and different. And so as a result, we are kind of flying the airplane. I think all our clients, and to some degree people writing the models, are saying, I'm not going to put this on autopilot. I'm going to watch the gauge, but I'm going to kind of steer around these clouds and recognize that any one of them might be a problem. And so as a result, in the policy mixes, when we talk about all these paradigms that we referenced, LDI and total return and real assets and Yale models, I think we're all recognizing inherently that even if we think that one model is good for us, there's a scenario out there that's real, that's going to be very bad for us. And so I think everybody's very cognizant about this diversification more than ever and looking at other return drivers. So in a sense, the policy of tomorrow will probably be some amalgam of all of these others that factor in real risk of deflation, real risk of inflation, and unfortunately, all we can say is at best we'll be half right, but at least we won't be totally wrong. And I think that's kind of in summary an assessment of the risk models that we're looking at.
I think the dynamical nature of risk and uncertainty is an important element, and it's very difficult for us as people to actually grasp this because they cover so many years. If you remember back to 2006, the VIX was at 10, right? And everybody said risk was low. And I remember hearing from many people that risk was low and it was going to be permanently low because globalization made markets more efficient, and because of that, volatility was going to be low indefinitely. And I could honestly tell people that in my career, that was the third time I'd heard that. There had been 2 other periods of low volatility, which chronically lasted for several years, and globalization was the general explanation for it each time. And what I think is happening with this time, hopefully, is that people are coming to the conclusion that markets are actually dynamical systems. If you want, which was the subject of my books, if you want to have a visual model for it, think of the market and the economy as more like a weather system. Rather than some sort of clockwork universe, which is the way most quants think of it, in that it's dynamical, it's complex, it has non-periodic cycles, which means that there are cycles, but the cycles don't repeat themselves exactly every time. We have these periods of high and low volatility, we have periods of growth, and we have periods of decline. Exactly when they show up and when they change, there is an average when they show up. The business cycle has an average, but the exact number is different every time. And because of this, the nature of risk changes dramatically, and so having one average number is difficult. Having one that looks backwards is difficult. You need things which do look forward. And we do have numerous things that do look forward. I mean, the VIX is actually one of them, because implied volatility tells us what people expect uncertainty to be. Credit spreads are another one. And the best quant factors as a quant manager are things that give you an indication but don't depend on any particular circumstance. Because if you try to model a particular circumstance, then that circumstance will never repeat itself, and you always get killed. That's one of the things that we know. So you need things like that, which actually are forward-looking but are very almost generic.
Yeah.